analysis of Hapseng and Huatai.
Every business operates on year-to-year basis, and at the end of each fiscal year, the management at the company is primarily concerned with how well the company did during that particular year. They will record the company's profit and its growth from the previous year. The reputation of the company in the sector is also valuable to them. Part of this project, we are going to look at the financial statement of a corporation in order to figure out which of the two businesses is the better investment for our capital. We will analyze their respective financial statement, the profitability, liquidity, and leverage position of these two companies that are listed on the Bursa Malaysia Exchange for the years 2021 will be compared in this analysis. We decided to go with Huatai Industries Berhad and Hapseng Industries Berhad as our two companies of choice. Within this study's scope, we will research and conduct financial analysis, evaluate financial ratios, explore the financial risk that this company faces, and study their organization cash management practice. Company background of Hapseng Industries Berhad. Hapseng Industries Berhad is a company that was established on October 4, 1991 and listed on the main board of Bursa Malaysia Securities on November 2, 2000. Hapseng Industries Berhad is a holding company for investment and has three subsidiaries: Hapseng Hunyong Brothers Sdn Berhad, Hapseng Perusahaan Makanan Sdn Berhad, and Incomix Food Industry Sdn Berhad. These subsidiaries are involved in the production and marketing of crackers, biscuit, and confectionery food items. The company was initially founded in 1958 as Hapseng Co. by four brothers, which in Chinese means success with teamwork. In 1974, Hapseng Perusahaan Makanan was established to support the growing company, and in 1977, Hapseng Hunyong Brothers was founded to oversee trade, and in 2005, Hapseng Industries Berhad acquired a 100% stock interest in Incomix located in the US. Company background of Huatai Industries Berhad. Huatai Industries Berhad is well-established biscuit manufacturer in Malaysia and has been listed on the Malaysian Stock Exchange since 1992. It has a wide range of high-quality biscuits and a strong distribution network that allows them to sell their product both locally and internationally. They use the trademarks Huatai and Luxury for their products. The company is well known for its high-quality product and innovation, and also has a presence in more than 50 countries. They have a strong presence throughout the supply chain from production to sales and distribution. They also distribute products from other manufacturers in Malaysia.
According to the data, Huatai Industries Berhad operational income for the year 2021 is in loss of 2,100,000 ringgit. A negative operating income means that the company cost of goods sold or operating expenses are more than its total revenue for the given time period. The operational income of Hapseng Industries Berhad is 34,700,000 ringgit. It demonstrates that the management of Hapseng Industries Berhad is increasing revenue while controlling expenses, manufacturing costs, and overhead. The table indicates that the Hapseng Industries Berhad's net income for 2021 is 27,240,004 ringgit. At the same time, Huatai Industries Berhad net income is a loss of 1,912,513 ringgit. On the income statement, Huatai Industries Berhad reports a net loss equivalent to a negative net profit. Huatai Industries Berhad has a net loss when its costs for a certain period are higher than its income for that same period. A rise in competition that leads to a decrease in sales and increase in expenses owing to higher material or convention prices and the cost of any debt issued to fund the firm can contribute to net losses. For the 2021 annual report, Hapseng Industries Berhad earnings per share are 3 cents, whereas Huatai Industries Berhad earnings per share are negative 3 cents. It indicates that Hapseng Industries Berhad earnings per share are more than these of Huatai Industries Berhad. This shows that the earnings per share after all obligations such as loan interest and dividends to preference shareholders have been satisfied. The 20% ROE for Hapseng Industries Berhad displayed in the table demonstrates the company's ability to create profit from shareholder capital. This profitability measures the company's efficiency in utilizing equity financing to support its everyday operation. On the other hand, the return on equity of Huatai Industries Berhad is negative 9%, which there was negative net income for the period. Both companies utilize ROE to predict long-term growth rates and dividend growth rates. Based on the return on equity, Hapseng shows a better ROE than Huatai.
Alternative capital structure is the particular combination of debt and equity used by a company to finance its overall operations and growth. To implement this in Hapseng, we would like to focus on the debt of the company, since Hapseng has higher equity. This company needs to take some risk by increasing some value of its debt by borrowing. As Hapseng is the world's largest investor in research and development, with this amount, Hapseng can invest more in R&D. This will help the company to gain more profit, increasing the EPS and ROE. Since Hapseng invests more in R&D, the operating income changes from 37.3 million to Rm 45 million. Next, we assume Huatai will issue common stock about 800,000. Therefore, the fund from issuing shares can be used by paying back the debt of the company. The value of operating income is increased to Rm 0.5 million and will help the decrease of the debt. The new net income of Hapseng is Rm 32.8 million, which is changed from 27.2 million. Hapseng can increase their net profit by increasing their revenues, such as selling more goods and services. In Huatai, however, has positive net income of Rm 0.5 million compared to the previous year, which has negative Rm 1.9 million. The positive changes indicates that the company has earned a profit and able to pay its expenses or debt. Moreover, the new earning per share of Hapseng is Rm 4 cent. The EPS increased by 1 cent than in financial statements. A higher or increasing earning per share indicates that the company is earning more profits to distribute to its shareholders. In Huatai, the EPS is Rm 1 cent, which is higher than in financial statements. The company will be more efficient at using its capital to generate more income, and the additional fund from additional equity financing can be used to pay off debt and improve the company financial statement. In Hapseng, the new assumption of return on equity is 23%. Previously, Hapseng had only 20%. There is a 3% difference in ROE. A growing ROE indicates that a company is generating more profits while using less capital. For Huatai, the ROE became 2% in 2021 from negative 9% in 2020. Due to the issuing of lower shares that decreased the number of outstanding shares has increased shareholder equity and the return of equity. When the EPS and ROE involve profits in Huatai, they have the capability to pay the cost of the company.
Liquidity ratios. Liquidity ratios are a class of financial ratios that measure a company's ability to meet its short-term financial obligation, such as paying off debt. They provide insight into a company's ability to generate cash flow and its short-term financial health. Some of the most common liquidity ratios include current ratio, quick ratio, and cash ratio. Based off the image, the current ratio Hapseng Industry Berhad is 2.86 times, which means when current ratio larger than 2, it is seen as a very strong since it shows that the firm has a lot of easily convertible assets into cash. Hapseng Industry Berhad is in a solid financial situation and can easily pay for the thing it needs. While for the current ratio of Huatai Industry Berhad is 1.035 times, which is slightly below the industry average of 1.2. This indicates that the company's liquidity position is relatively weak and it may struggle to meet its short-term financial obligation. Next, Hapseng Industries Berhad quick ratio is 1.6145 times, is higher than the industry average, indicating that the company is in a good position to meet its short-term financial obligation. While quick ratio for Huatai Industry Berhad is less than 1, is considered to be less desirable as it means that the company does not have enough liquid assets to cover its short-term liabilities. Cash ratio of 1 is considered to be minimum level required to meet short-term obligation, as it means that Hapseng Industry Berhad has exactly enough cash and cash equivalents to pay off their current liabilities. The cash ratio is 1.078 times, is higher than 1, indicating that the company has a good liquidity position and is able to meet its short-term financial obligation. However, for Huatai Industry Berhad, the cash ratio is 0.176 times, which is much lower than 1, indicating that the company may have difficulty meeting its short-term financial obligation if it does not have access to other sources of liquidity. How is company financing its asset? Financial options are ways a corporation can earn capital for operation, assets, and expansion. Debt financing dominates borrowing money from bank, financial institution, or bond market. Loan, bonds, and credit line are examples. The corporation must repay the loan interest. The type of financing a company chooses will depend on its needs, goal, and willingness to take risks. Each choice has its own and cons. and companies should think carefully about the cost, terms, and possible effect on ownership and risk before making a final choice. For both company that we have chosen debt ratio. Debt ratio represents a company's debt finance asset. A corporation with a high debt ratio is more financially risky. If its revenue fluctuates, a firm with a high debt ratio may struggle to satisfy its financial commitments. A corporation with a low debt ratio is less financially risky. For Hapseng Industries Berhad, debt ratio is 0.328, lower than 0.5, suggesting lesser financial risk. This might be due a robust cash flow or a prudent borrowing program. While for Huatai Industry Berhad has a debt ratio of 0.6763, which is greater than 0.5, suggesting a higher financial risk. Debt or asset reduction may cause this. They may need to cut debt, boost assets, or enhance their debt to assets.
The capital structure has an indirect effect on the company's return by affecting the company's possible future access to further capital. A company can recapitalize by trading its debt for equity. It can increase its debt by issuing corporate bonds or taking out a company loan and then utilize the leverage to repurchase some of its stock through a share buyback. In contrast, if a company thinks that its debt is out of control, it may issue additional shares. The new stock offering will generate cash in return for equity, which may be used to repay a loan or lower the company's debt. Prior to presenting alternative capital needs, the calculation above depicts Hapseng and Huatai's capital structure calculation. According to our study, Hapseng value without debt soared to 734,345,850 ringgit in 2021 as a result of its massive market expansion and capitalization, while Huatai value without debt was slightly less than Hapseng at 4,250,627 million ringgit.
For the value of the firm with debt, Hapseng Industry Berhad is 126.4 million, but Huatai Industry Berhad is negative 30.37 million. It shows that Hapseng Industry Berhad is higher than Huatai Industry Berhad. For the value of equity after market capitalization, Hapseng Industry Berhad is 24 million, but Huatai Industry Berhad is negative 4.5 million. It shows that Hapseng Industry Berhad is higher than Huatai Industry Berhad.
The calculation for the cost of equity after market capitalization for Hapseng and Huatai companies is calculated using the capital asset pricing model, where it evaluates if an investment is fairly valued, given its risk and time value of money in relation to its expected return. For Hapseng, the cost of equity is 5.687%, which is slightly higher for the company. This illustrates that the Hapseng has a high degree of risk because it has a higher cost of equity. It is risk for the investor to invest into the company, as the cost of equity measures of how much return a company must generate to keep its shareholder invest in the company and raise additional capital when necessary to keep operations going. As for Huatai, they have a cost of equity of 4.187%. It is slightly lower than Hapseng COE. A low COE indicates that investors are more likely to take the opportunity to invest because COE can be used by investors as a benchmark for an equity investment. So, it can be concluded that the higher the cost of equity, the higher the risk for an investor, while the lower the cost of equity, the lower risk for an investor. However, it should be noted that high risk can give high returns, and it depends on whether the investor is willing to deal with the high risk or not. In Hapseng Industries Berhad, the weighted average cost of capital is 22.71%. A firm's WACC is likely to be higher if its stock is relatively uncertain or if its debt is seen as risky because investors will require greater returns, whereas for the Huatai Industry Berhad, the WACC is negative 5.81%. A negative WACC indicates that equity is negative. One of the dangers of negative rates for investors in regulated utilities is that it means that equities may not offer as much return in absolute terms to reward equity investors for the additional risk they take on compared to debt investors. In knowing if the manager is generating operating profit on the company's asset can be seen from the calculation on return on assets of the company. A ROA of over 5% is generally considered good and over 20% is excellent. Based on the calculation, Hapseng's ROA for the year 2021 is 18%, which means for every ringgit of assets the company invests, it returned 18 cents in net profit a year. While in the year 2020, it recorded the ROA of 24%. Therefore, it can be concluded that Hapseng's ROA shows a decrease of 6% from year 2020 to 2021. Also, the ROA of 18% in 2021 almost shows an excellent result, which near to 20%. Next, from the calculation, it can be seen that Huatai's ROA for the year 2021 is negative 2.9%, which means a negative ROA is a sign that the business is not obtaining the expected benefits or that it is generating losses. Hence, what Huatai should do to increase the ROA is increase the profit margin or try to make maximum use of the company assets to increase sales.
Hapseng Industri Berhad is a food manufacturing company. Therefore, the factors that may affect its current and future performance include: first, economic condition. That is, economic downturns can lead to decreased consumer spending, which can negatively impact the company's sales and profitability. Second is competition. That is, increased competition can lead to lower price, reduced market share, and decreased profitability. The third is raw materials. 4. Government regulation. 5. Consumer trend. 6. Distribution channel. 7. Technology and innovation. And the last is brand reputation. In water industry, which is a leading manufacturer of confectionery and bakery product in Malaysia, there are several factors. That is, first, economic condition. That is, economic downturns and recession can negatively impact consumer spending and demand for Huatai products. The second is competition. Huatai faces competition from both domestic and international competitors, which can affect its market share and sale. The third is government. The fourth is supply chain distribution. 5 is innovation. 6 is branding and marketing, and the last is consumer trend.
Based on the comparison the company performance of Huatai Industri Berhad and Hapseng Industri Berhad for 2021, we have found that both companies have strong liquidity, but Hapseng has a higher profitability and has lower debt ratio. We suggest that Hapseng focus on maintaining and improving profitability, and Huatai focus on maintaining low debt and reducing financial risk. However, it's important to note that this analysis is based on publicly available data and only covers 2021, and more context is needed to fully understand that the company's long-term performance. Overall, we provide an in-depth analysis of the company's financial performance and suggest areas for improvement.